Right. Sorry, for those listening to the recording, really we just talked about why one would do the 3-day or wouldn't do, as the case might be, the CFP 3-day prep or the QAFP 3-day prep in October, November. We didn't cover any content stuff yet, but I apologize. I missed recording the first 15 minutes, which sometimes happens, Kamal. See that? That's a problem with the recordings occasionally. But what I will say around that for those who are watching the recording is if you have questions about what you're signed up for, that's a great reason to contact Kelsey. Okay. Kelsey, if you don't mind, can you just repost your contact info in the chat box so it shows up with the recording? Okay, or maybe Kelsey's ducked out already. Oh, thanks, Kelsey. All right, you beat me to it. So the last question I have, carrying on with where we left off last time, is what reason would somebody have to either stay in their pension or to leave the pension / take the commuted value? Okay, so why does somebody stay in the pension? Okay, these are two important considerations. Trevor, health is the easier one to understand here. Let's talk about age in a second here. But generally, in good health, or if you have a long life expectancy, that would be a reason to stay in the pension. That's fair? Yeah, we talked about something similar, Olu. All right. Okay. Yeah, so it's a very safe choice, Elizabeth, right? This is the safe choice. Although we'll talk about why there might not be safety here in a moment. So Chris, you know you're going to get that check every month, right? Known income in retirement, which ties into Elizabeth's point around safety, right? Okay, so in fact, Sheik, I would argue the opposite. I would argue that if you're making a solvency argument, that would be a reason to leave the pension, wouldn't it? You do have better income splitting options here. You can split income before the age of 65 that way. That's a good point, Greg. Absolutely. Okay, again, Chika, we're going to look at reasons to stay in the pension. All right. And I would suggest that your estate needs are a reason to leave the pension. Is that fair? So we can talk about those over here. Okay. So if there's a solvency problem with the pension, or if you have estate needs other than for a spouse. Okay. All right. Any other reasons to stay in the pension? Possibly Olu, yeah. So some pensions provide health and sometimes other benefits as well. What I'll call secondary benefits, like social memberships or educational benefits. Okay. Yeah, you don't need to manage anything, right? No investment management or asset management, which again ties back to Elizabeth's point about safety. Oh, help me out here with more tax efficient if you're leaving the country in retirement, Kevin. Okay, so Sue, I want to park the index benefit. Hang on to that thought for a second, okay? Because I don't necessarily agree with that, and I'll show you why in a minute here. And there's a corollary to that, Sue, that we'll talk about in a second, okay? Yeah, and that ties in again to that asset management question, Elizabeth, right? So we'll come back to the inflation protection thing in a second here. Trevor, I'll show you why I'm not going to put that on the list here. Okay, so that's that steady income, Yuri, right? So we already heard about your known income in retirement. And I think the professional money management ties in there. Shika, you keep giving me these points for the right-hand column. We're dealing with why stay in the pension right now. All right, good. Now, the commuted value question. So one of the comments I will make here is that your maximum tax deferred transfer value may be very costly. You might lose a lot to taxes here. Okay, we talked about that last time we're together. Jen, I'm not sure if I follow. What's the difference between the left-hand column and the right-hand column? And this is the same question I have for Kevin with taking this as foreign income. So I've never seen that, Kevin. I've never seen a circumstance, and I know what the Income Tax Act says about this. I can leave the country. There's nothing in the Canadian Income Tax Act that compels me to deregister, or sorry, to dispose of my lira. What have you seen here, Kevin? So yeah, we might find the spousal or survivor's benefit attractive, and in fact, okay, but Jen, I don't have that option here, right? We're not comparing anything to an RCA. And the RCA does, in fact, the RCA is exactly the same for that purpose. Both create the same effect. Both create a 25% withholding tax on withdrawals from the plan. So if I'm taking money from an RCA or taking money from a lira or taking money from a defined benefit pension, if I don't file a Canadian tax return, I'm going to pay a 25% withholding tax in all of those cases. Okay. All right. Yeah, an RCA is not a comparison we can make here. So, yeah, and related to that, Michelle, so you may not have a choice. So this ties into the survivor's benefit idea. You may simply not have a choice. We need a spousal waiver if you're still married. And to your point, Michelle, you may have made a promise already as part of a separation agreement. That's fair? Okay. Isn't it the opposite, Olu? Okay, but I can already income split my pension after 65, right? So I'm not sure that I see the benefit there. I would say that we have it right on this side, that we have better income splitting options by staying in the pension. Yeah, that's fair. Come on, you get the pension credit, which is related to that income splitting. So you get the pension credit before 65. Okay. Survivor benefit. Yes, that's a really good point. And in fact, Ron, what I'm seeing more and more of is exactly that position taken. The pension may not allow commutation. And sometimes that's age related. Sometimes just the pension says we just don't give that option. Okay. So is that a reason to stay in the pension, Chris? The age difference? It's certainly something we want to work into our planning, isn't it? I don't know if it's a reason to stay in the pension. Are you then thinking of the survivor benefit, Chris? Right. The caution I would levy there is that some pensions, not every pension does this, but some pensions are going to ask you how old your survivor is. So if they're 15 years younger than you, you may find that the pension will actually reduce your benefit. They say, well, we're going to end up paying a more generous survivor benefit. Therefore, you're going to get a smaller pension benefit now. So some pensions actually do adjust, make that actuarial calculation based on the age of the survivor. Some of them just assume a sort of broad brush approach to it. Okay. So Devin, that's, yeah, 60% or 66% are the normal defaults under provincial pension legislation. Some pensions will allow you to bump that to 75% or 100%. Okay. Okay. Any other reasons to stay in the pension? So yeah, I don't like, I mean, I can live with the first half of your comment, I think, Ron. I think the second half of your comment is kind of tongue in cheek, right? But yeah, if I have somebody who already has a good RRSP or invested assets or whatever, yeah, that's true. This can form sort of the fixed income portion of a diversified portfolio. Is that fair, Ron? And this ties back to Elizabeth's comment earlier that I have a professional money manager different from the other professional money managers I might be using. Right. Remember the $2,000 pension credit, Baljeet? The criteria to qualify for that pension credit are exactly the same as the criteria to be able to split your pension income. So you don't get that pension credit on a RIF withdrawal before 65, but you do get it on a defined benefit before 65. No, remember, defined benefit, it applies at any age. So if you have a teacher who's 53 and taking pension income, that teacher does get the pension credit. If they're splitting pension income with their spouse, then the teacher and their spouse both get the pension credit. Okay. So I have the health benefits in here. Kamal, I have health benefits fourth down the list. Okay. No, forever, Baljeet. It doesn't cut off at 70. Okay. We'll talk about the bridge in a second, Kamal. I feel the same way about the bridge as I do about indexing. So hang on to that comment. Okay. All right. So yeah, Yuri, we have that comment. So why would you leave the pension? Okay. Well, we talked about solvency. To me, solvency is the #1 reason to leave a pension. Okay. If you're looking at a pension plan that has a solvency ratio of well under 90%, that's, if you're allowed to leave, that's a good reason to leave. Okay. Now back to, I think it was Kevin's comment earlier. In a case like that, oh no, sorry, Ron's comment, the pension may not allow you to leave. So you're thinking of your LIRA to LIF rules, Ron, right? So I agree that LIRA to LIF in most provinces, the lowest age you can do that is 55. In some provinces, notably Alberta, you can make the LIRA to LIF decision as young as 50. Okay. But 55 is good to know for the exam because that's the federal rule. But if you had somebody who met their qualifying factor and all that kind of stuff before 55, yeah, you could have a defined benefit pension before 55, Ron. Yeah. Exceedingly difficult to do that today. But if we rewind, I'm sure some of you have seen this. I'm sure some of you have clients who are doing this. I'm sure there's a few people who have either ex-RCMP or ex-military clients who started their pension when they were in their late 40s. It's gotten very difficult to do that, but if you retired in the late 90s or early 2000s from either of those professions, you would have found lots of people starting pensions in their late 40s and early 50s. Okay. Any other reasons to, okay, so the ability to unlock Kamal might be a reason to do this. And that ties in overall to increased flexibility. Okay, basically, you have, instead of a fixed amount of income, you can move your income around. You can take lower and higher income, still within your LIF limitations. And you can wait till 71 to start income if that's appropriate. So you do get more flexibility that way. All right, why else would I take the commuted value? So again, I'm going to make that same argument, Ron. I do not think that's actually a good reason to take this, and I'll show you why in a moment, okay? We're going to get into this discussion. This is going to tie in as well to the bridge benefit comment that came up. So it's a fair point, Kamal. If you are an investor who has some reasonable level of risk tolerance, doesn't have to be through the roof, but you have some risk tolerance here, some ability to manage investments, and you want to manage your investments, okay? Okay, so Kevin and Sue have a very similar point here. If you have this shortened life expectancy or poor health, perfect. And that comment about other children, I would suggest that ties into estate needs other than for a spouse, right? So your comment here about dependent children, I think fits nicely. Okay. Yeah, so more control, Elizabeth, right? So, okay, I can buy that, Kevin. If I have somebody who's going to go to the United States and invest there, okay, I can live with that. Yeah, that's what I was looking for, is why the taxes mattered. And that's a good argument, Kevin. I do like that. Okay, so more control in general, if you just like to have control. Now, my one comment about this is a good point, Sandra. Let's come back to that. So my one comment about control, you might very well see somebody who has a lot of willingness or ability to control and invest when they're 62, 63, 64, 65. What about when that person is 82, 83, 84, 85? I always have that concern. Now, you could annuitize at that point. Okay. So yes, if you, this is a pretty complicated point Kevin raises, but it's true. If you are going to retire elsewhere, you may get more tax efficiency by investing properly, even within your registered portfolio. Okay, so that's a fair point, because depending what you're holding, that can have tax consequences in the country you retire in. Okay, so Sandra points back to the left-hand column here and says you have a reduced likelihood of elder abuse or investment scams. Okay, that's really good. Yeah, it's true concerning the RDSP. Okay, with the RDSP, that ties into your dependent children. So again, yeah, maybe RDSP funding. Okay, perfect. Yeah. Sorry, Shauna, right? I apologize. I'm losing your name again. I know that happens every time. All right. So I'm not sure which argument you're making here, Shika. Is that an argument? I don't follow the argument here. Wants to leave the employer at a specific age when pension is forced. So when you leave, Devin, there's no tax on departure. It's when you take money as a non-resident. So if I've got $500,000 in my LIF on the day that I leave Canada, I go become a resident somewhere else, I still have $500,000 in my LIF the next day. Okay, that's not changing. And then let's say that year, my minimum withdrawal, and that's all I take my minimum withdrawal of $25,000. I'm going to pay a 25% withholding tax to CRA on that $25,000. That'll come right off at source. Okay. Yeah, so you might have other than, that ties into that idea of control, but yeah, that's a fair point, Elizabeth, if you have somebody who is looking for certain investment screens. So if you want ethical investing, that's a, you know, or some version of that, then yeah, absolutely. So yeah, if you're carrying a lot of debt, Kevin, that's a fair point. If you're carrying debt and want to pay it off, this might be the best way to go about that. Okay. Yeah, you can, Yuri. There's no restriction with most pensions on such an activity. What you want to check is, how does the Canada-Poland tax treaty deal with that? So you have to find an accountant who's willing to negotiate or navigate the Canada-Poland tax treaty in that case, because you want to make sure you're not going to have double taxation. But if it's like most countries, you're going to have a 25% withholding tax in Canada, which is potentially recoverable when you file your Polish and or Canadian tax returns. Maximum transfer value is what was being pointed to there, Tracy. Kevin is just talking about taking the non-reg amount, that amount beyond your maximum tax deferred transfer value, and using that to pay off debt. Yeah, okay. Right, so Devin, that's exactly the same as Yuri's question, right? You would have to look at the specifics of the tax treaty. And depending on what the tax treaty says, you're generally going to get rid of any opportunity for double taxation. Okay, Poland's going to be a little bit different here, because Poland has its own income tax structure. A lot of times people are going to retire to places without an income tax, and that's going to change that outcome a little bit. Okay. All right. Now, I think this is a good summary of why we would make either decision. This is actually a lot like PEP, isn't it? For those doing your PEP. Okay. I do want to point out, though, that an answer that sometimes comes up here that I'm not a fan of, and I'll show you why. So some people say something like low interest rates, okay? Or some people will say because of the bridge benefit, or some people will say because of indexing, okay? To me, these are neutral considerations, and I'll show you why. So let's say that I have a pension, just for the sake of argument here, I have a pension where the base benefit is going to be, just to have a number, $30,000 a year at age 65. Okay, everybody's with me here? Now, I'm going to split this out. I'm going to have scenario A. In scenario A, we're going to have a bridge benefit. Okay, we're going to have indexing. That's good. And in scenario B, we have no bridge and no indexing. Okay, so which is the better pension here? Which pension would you rather have? You would rather have A, right? Both that pay $30,000 a year, but A is indexed and gives you a bridge benefit, and B has no bridge and no indexing. Okay. Okay. So everybody, Kevin, are you with me there? In both cases, Kevin, both are going to have a benefit, a base benefit of $30,000 a year at 65. So there's not really anything left after, right? Or, okay, I see what you're saying here. 30,000 a year is the amount left after, okay? So your bridge is only paid prior to 65, right? Your bridge ends at 65, so the 30,000 a year is what pays before that, okay? Or sorry, pays after that, I apologize. So it'll be a larger benefit for the, whatever it is, 5, 6, 7 years before. Okay, so let's say that I have two people who are both considering their commuted values. And just for the sake of a hypothetical here at age 54, okay? So I'm not gonna tell you, we're not gonna do a time value of money exercise, that's not helpful here. But what you're gonna see is that A is gonna have a commuted value of something like let's say maybe $500,000, okay, just for the sake of argument here, where B is going to have a commuted value of something like maybe $350,000. Okay. Is everybody with me there? And the reason for that is because the commuted value for A is going to show up, or is going to incorporate those additional benefits. Okay. It's more income because of the bridge benefit, and it's a better stream of income because of the indexing. Those two things are going to show up in the commuted value calculation. Is everybody with me there? So really, in both cases, the actuary who's doing the commuted value calculation is asking, what would it cost to buy exactly those streams of income? Okay. So do we buy that argument? Do you see why I suggest that at least the bridge and the index don't make a difference here? Okay, now I want to work through two more scenarios here. So now, same thing, I've got my $30,000 base benefit, but now I want to do a scenario C. Okay, and this person is retiring when fixed income returns are, call it roughly 5%. Okay. And in scenario D, this person is retiring when fixed income returns are roughly 3%. Okay. So what is going to happen when we look at those commuted values? Again, if we're going to compare commuted values, what are you going to see in C versus D? Which one is going to be the better commuted value? That's true, Kamal, right? So we're going to see something like this. We might have C at, I use the same numbers, might be $350,000, and D might be $500,000. Because again, the actuary who's doing the commuted value calculation is going to ask the question, what does it cost to replace that cash flow? Okay, it's going to be cheaper to buy that retirement cash flow if I can get a 5% fixed income return versus buying that cash flow when I've got a 3% return. That's why we see these really ridiculously high commuted values today. Okay, it's exactly right, Chris. The bond is, it is a bond. Really, your pension is a bond, right? It's just a promise of a stream of income. So Chris is right here. Lower rates mean higher prices and vice versa. Okay. Okay. Now, what's the challenge here? If I'm retiring, okay, would I rather be retiring when fixed income returns are around 5%, or would I rather be retiring when fixed income returns are around 3%? Is that true? If you have a, are you arguing for a lower rate of return? Is that what's happening here? Isn't that the argument you're making when you say 3%? No, lower interest rate means higher bond prices, Elizabeth. Lower interest rate means lower bond rates, right? Okay, so, but on day one of retirement, Elizabeth, if interest rates are all 3%, so I've got to take my assets and I've got to buy a cash flow, right? I'm retired, I don't have a job anymore, I've got to buy a cash flow. Would you rather be buying that cash flow when yields are 3% or when yields are 5%? So that's what, yes, I agree, Elizabeth. That's exactly why I showed that, right? Your 3% yield means you're going to have a higher commuted value. But now what am I doing with that commuted value? What am I doing with that $500,000? Okay, perfect. I guess if that's true, Elizabeth, then I don't care about fixed income yields, right? But you have to take that money and invest it, don't you, Mel? Okay, now, sure, if you can do what you're suggesting, Elizabeth, and invest in all equity, and in fact, I don't know if anybody pays attention to him or not, but Michael Kitces was just on the Rational Reminder podcast talking about this, and he kind of jokes about it on there where he says, you know, mathematically, it is actually still the best thing to have that 65-year-old who is all equity, okay, just like Elizabeth is joking about here. But the problem is for a small proportion of those people, if that first couple of years of retirement is terrible, now it's going to be extra terrible. Okay. So yeah, and I agree, Elizabeth, you want some equity. I'm not suggesting you're going to be 100% fixed income, but you have to take a fairly significant portion of those assets and buy fixed income assets, don't you? Okay. Now, when you say, if I'm going to take a larger equity component, are you with me here? If you're going to argue for taking a more aggressive approach to retirement, we've already addressed that. You already addressed that right here when you talked about having some degree of risk tolerance and wanting to manage investments. But if that's not true, then I'm going to have a significant portion of my retirement assets tied up in fixed income. And it's true, Ron, I get some fixed income from CPP and OAS. And again, same comment that I'm making around Elizabeth's argument here. If that frees me up to go and invest a bunch in equity, then I would suggest that I've met that criteria. Okay. Now I'm less concerned about those fixed income returns. But if I have to be sort of as concerned about fixed income as anybody else at my age, then this really does get to be a concern. Okay, do you see where now what the argument you're really making is here? It's not about what fixed income yields are. It's about not even investing in fixed income. Is that fair? Okay, so I think you agreed with me right from step one, Mal. So I don't know. I'd like to hear from those who didn't agree with me from step one. So if I have $350,000 available, okay, and I can invest, okay, I have ready access to 5% fixed income instruments, it's going to be pretty easy to fund retirement. You with me there? Whereas if I have the larger amount, the $500,000, and now I can only get 3% in my fixed income portion of my portfolio. So it's a valid point, Ron. Generally speaking, though, inflation is linked to my fixed income returns, right? And today is a great example of that, right? We have rock bottom inflation and rock bottom fixed income returns. Is that a fair comment? We might even have some deflation here for a while. And we might even get some negative fixed income returns. Is that a fair comment? So I can only get 3% in my fixed income instruments. Now it's very hard to fund that retirement. Okay. Yeah, weird times anyway, Shika, right? So does everybody see this? Do you agree with this? Okay, I think you're in the same boat, Greg. I think you and Mal are in the same boat here. You must have some sort of Western Saskatchewan connection here, where people from Western Saskatchewan find this self-evident. All right. Or are you from Eastern Alberta, Greg? Okay. There you go, Mal. All right. Anybody not understand the argument that I'm making? Okay. Now, this is a true story, Ron. So again, though, I would suggest that ties into that orange box I have in the middle right, or brown box, whatever color it is for you, in the middle right of the screen. Because if I think rates are going to go back up, well, now I'm really doing a little bit of market timing, aren't I? Okay. And I don't know what's going to happen with rates. Right, that's the point, Baljeet. It depends, or sorry, it roughly balances out. That's my argument. That's why I'm not willing to put high or low interest rates on one side of this page or the other, okay? Because it does balance out. Mathematically, it has to. That's the whole point of the actuarial calculation, okay? All right. Okay. Is everybody with me there? I like this discussion because we cover a lot of ground here. It's one of the reasons I like this should I stay or should I go question, because we get a little tax review, we get to talk about asset allocation, we get to talk about retirement income planning, even to a lesser extent, insurance. Somebody brought up an insurance comment. Ron, I think you brought up an insurance comment that I didn't actually address. Can't remember what it was now, sorry. Let's see if I can find it here. Oh, that was, yeah, here, I'm just gonna copy it, I got it. So this is Ron's question from earlier. It should not happen that way, Ron. It shouldn't happen that you're, well, maybe you're, okay, but why does it matter about the rest of my net worth? Shouldn't I just be looking at the commuted value from the pension? I guess I don't know why I'm bringing other assets into the mix. Because no matter what, I still have those other assets, right? Now, we did talk about the possibility of a diversification argument here, and that's where the other assets could be material. Right, I guess I just don't understand in your brackets, or you have net worth including commuted value. But so that depends on the assumption you use, Ron, right? And that very much goes back to this you are an investor scenario and Elizabeth's comment about going 100% equity, right? Because yeah, if I use a 6% return, then the commuted value is going to look better than the pension because my actuary is not using a 6% return. Okay. I don't think you would, Sue. I think that you could still work that into an argument. Okay. It's a tough one to get in there. Do you see how it's very difficult to actually support that position? And I think when you're making those arguments, you're really coming back to that you are an investor position. Okay. And we have plenty of other ammunition with which to answer this question now. So you don't even have to worry about trying to give that answer. Okay. That's good. If we only had 2 or 3 answers, Sue, I'd be concerned about that. What else would it be, Ron, other than fixed? I'm not sure if I follow. We're talking about a defined benefit pension here, Ron. Right? We are specifically talking about a defined benefit pension. So I don't know if we're making an assumption that the client's pension is all fixed or if that's a stated fact. Okay. Yeah, I have to have some fixed income element here, Baljeet. Or you can try this, Baljeet. Next time you get a 65-year-old come to see you, put them in a 100% equity portfolio. Want to try that? That's what I thought. All right. Go ahead, Yuri. Yeah. Oh, okay. I wasn't sure you can, I can't remember how to get you to, there, I got it. Okay. Whew, how was that? Okay, I like it, Olu. That's what we're here for, right? A little bit of depth is okay. I don't want to go through every item on this list. Okay, so Ron, can you make that comment public? Yes, it is easier at a younger age. And actually, age was one of the very first items that came up in that discussion. I do think younger people will generally benefit more from taking their commuted value. And that again ties into that investment and control question, because that person can, that person can really invest for the long term, right? So a 40-year-old who has this discussion is in a lot different position than a 55-year-old even who has that discussion. Yeah, so Ron, the rate of return that your pension is reporting is almost irrelevant here. Okay? You could make the same argument, Ron, about an insurance company and its reserves. That when I look at, let's say, a whole life policy reserve, the return is going to be in excess of fixed income returns. It has to be, right? Because there's going to be some equity stuff in there. There's going to be some illiquid stuff in there. Is that fair? But what you're really doing with your pension is the same as with your whole life policy. A good chunk of the funding, or a good chunk of what it takes to actually make the pension work, comes from ongoing contributions. So it's not like your defined benefit pension has enough money to meet their promises. They have to continue to draw member contributions in, right? So you can't look at the pension's return. You have to look at the overall position. You have to look at a pool of dollars plus minus distributions plus income. That's really what you're dealing with, right? So don't look just at the pension's return. And if I have a pension that's only 70% funded and it gets a knock of the lakes return, it's still going to be underfunded. You buy that? Yeah, and I agree with Elizabeth. I don't think it's an out of line comment, Ron. Okay. And I do think that's a source of confusion. I think some people look at that and they say, oh, hey, my pension plan. And in fact, we can make that argument with Canada Pension Plan, right? Canada Pension Plan proudly releases its results every single quarter and tells us how they, beat their benchmark, which they almost always do. But that doesn't necessarily mean that my CPP is going to be any better, right? What it does mean is that the government's not going to have to come to me later on looking for more money just to keep CPP operational. And by that, I should say more than I'm already contributing. Okay, now I had promised we would talk about memorization here. And yeah, exactly right, Chris. And the CPP thing, I think, matches the sustainability comment nicely here. Okay, so this is a very light exam, and those that have written the QAFP and here getting ready for CFP, I think will vouch for this, that when you're writing the exam, you're not going to be sitting there wishing that you had memorized a bunch of extra information. Okay, those that have written QAFP or level 1, if you had that happen on the exam, I'm guessing it happened on 1 or maybe 2 questions. Would that be a fair comment? And when I say memorize, what I really mean here is facts, figures, formulas. Okay. Tell me if I'm wrong, folks that have written that first exam. Instead, it's mostly about structure. It's most, yeah, and Mal, you may have gotten through the whole thing without, yeah. Oh, okay. So, and even there, Michelle, 1 question, right? You didn't have 12 questions where you had to know Sharpe ratio, right? So your worst case scenario here is maybe you run into 2 or 3 questions on the exam where it would have helped to memorize the Sharpe ratio or to know your early and late CPP percentages or something like that. But that's it. That's what you're going to see. It's just not something you should be heavily focused on. Okay. So I have put together a list. I think this is a pretty good list of items that I think are worth memorizing. Okay. And really, you don't have to go any farther than this, I don't think. Okay. Maybe if you wanted to, maybe what you could do that I don't know, I might look at is your RESP and RDSP grant amounts. Maybe I could tack that onto this list. Okay. No, Aida, in fact, I can't think of a single thing that would show up. Maybe the lifetime capital gains exemption, a rough amount, Aida. Yeah, all those rules, Elizabeth, you absolutely have to know all those rules, right? So you have to know how the RESP works. You have to know how the RRSP works. You have to know how the TFSA and RDSP work, 100%. Okay. So yeah, and I even have some of those on the screen here, Elizabeth, right? So, well, in fact, I could have put the 18%. So that's a fair comment. I could add the earned income calculation. I guess I just assume that everybody knows it for RRSP, okay? But your rules, absolutely, okay? That's a different thing. When I say facts, figures, formulas, that's different, okay? But absolutely, the functioning registered plans, 100% know this, okay? And I'm going to show you something on the next page here, actually in a few pages, where we're going to work through a couple of questions where you'll say, oh, maybe I had to memorize something here, okay? But I don't think it's necessarily the case, so we'll have a look. Maybe we'll flesh this list out a little bit more, but if we're going to add to it, we're not going to add a lot to it. Okay, this is really designed to put your mind at ease. No. So those figures, Connor, that change every single year, like your RRSP maximum deduction limit for the year, no. Now, what you should know, Connor, is that it is about $28,000, okay? And you should know that that correlates to about $150,000 of income, okay? That's good. I think that's 154, right? 151, right? So, okay. All right. Yeah, and that should be, those questions will be fairly obvious, Elizabeth. You're not going to have somebody who's making $151,200 and know that they're not quite maxed out. You're going to have somebody who makes $200,000 And you have to know that that person's maxed out. That's fair? Or that they're making $100,000 and that they're not maxed out. So yeah, absolutely. Okay. No, again, you're not memorizing. Okay. You're not memorizing the exact amount. Any amount that changes like that every single year, do not memorize it. When I say the OAS GIS clawbacks, I don't mean the dollar amounts, I mean the calculation here. Okay. So you know that over $80,000. Yeah, it's on the formula list, Baljeet, so I'm not as concerned about it now. I'm taking real rate of return off my list. Okay. What do you want to memorize here, Kamal? Tell me what you're actually giving. What's the memorized thing you're thinking here? No, again, that's an amount that changes every single year. Okay, so no, you're absolutely not going to memorize that. Okay, now that being said, again, same comment here, Kamal. And in fact, we're going to see a question like this on this today. I should know that somebody who makes $80,000 a year is going to get some childcare benefit. Are you with me there? Whereas somebody who makes $200,000 a year is not getting any childcare benefit unless they have a whole van load of kids. Okay. That's right. Right. I don't. If it's an amount that changes every year, do not memorize it. Okay. All right. And you know that the Canada Child Benefit changes every July 1st. It's indexed to inflation, right? Shows up in section 117.1 of the Act, indexed to inflation. All right, that's the comment that Elizabeth had before, Chris, right? So the functioning of registered plans, absolutely, you have to know all the ins and outs, the mechanics, as you say, okay? The mechanics of the Canada Child Benefit. Yes, I have to know that, okay? Maybe, Yuri, that's a little bit of a stretch, but maybe. It's not inconceivable you could see the PR formula on an exam. I don't know. I guess I think of that. It's such a simple formula anyways. Okay. Yeah, but again, I think if you messed up on it, you probably messed up on a conceptual problem, right? That kind of thing. I find if you get the concept down, the formula is simple. I don't generally see people who understand how the exemption works but don't know how the math works. Okay. All right, any questions? Yeah, that's a mechanical rule, Elizabeth. Back to Chris's comment, right? That's a mechanical rule that you have to be aware of, right? That you can be out of the home for a period of up to 4 years and still use the exemption, but that's nothing to do with the formula, right? Okay. Whew. And that's the kind of thing that's going to show up on an exam question. Okay, that is exactly the kind of detail that FP Canada will use to make sure that you really have a deep understanding of a topic. Okay. I really want to emphasize this. It's not a memorization exam. It is a comprehension exam. Okay. All right. Now let's have a look at credit and creditworthiness. No, not necessarily, Devin. That's a case by case. Some financial institutions will allow that transfer straight into an RRSP with no withholding tax. Okay. Sorry, some RS or some pension sponsors. I apologize, not financial institutions, but pension sponsors. Okay. All good. That's a case by case though, Devin. There's no rule for that. No, again, no mandatory withholding tax on that. No. Okay. Now, let's have a look at our 5 C's of credit. Okay, and actually, as you say that, all right. So let's have a look at this tool. Now there's a bunch of bankers on the call, right? We have, I think, about 15 bankers on the call, which I find very, and I think some ex-bankers too. I think there's 4 or 5 ex-bankers on the call. And I find that useful. I'm honestly pretty daring of me to go through what we're going to go through in a couple minutes. So, right. So that's why we're doing this, Chris. Yeah. Oh, that's funny. All right. Man. So, yes, this is something that we will now see to exactly to Chris's comment, to a greater emphasis on this exam. Okay. And that's why I have it as a teaching topic here. So if you need review on this, chapter 3 of core curriculum has tons of stuff here. Okay. Why the emphasis on credit, or why wasn't it there before? Right. So, well, both exams, Greg, both exams. Man, it's a lot for me, Olu. I don't want more than that, honestly. All right. So the, I appreciate it though, Olu. All right. So why do we have this? So what's happened here? And sorry, I honestly, it kills me. Your first name, Sheila. I'm stretching for it here. Yeah. So Shauna, I apologize, Shauna. Now I can fix it. I called you Shauna before, didn't I? And I had it right then. I should have renamed you. All right. Your apology card is. I don't like getting people's names wrong, Shauna. I legitimately don't. But anyways, I got you now. So, so yeah, chapter 3 of core. So yeah, this is kind of the point that Elizabeth makes here, is that what FP Canada is trying to do, and there's a whole, like, this is a giant history question you're honestly asking me, Shauna. I could go back to 1997. I actually could go back to 1967 if you want to answer this question. But what it comes down to is that I would suggest that financial planners to this point have had a sort of by default focus on high net worth. Okay. And there's this recognition that credit is something that increasingly causes people problems. So I think, and you tell me with your clients, are you more likely to run into a client who's in financial trouble because of how they invested or because of how they borrowed? And that's it, Mal, right? So it's not even restricted to that sort of middle income market here, right? And I think this is the point. I think that almost everybody's going to agree with this, unless you're dealing in a very specific demographic, but it's that credit causes problems. So, and really, and I'm going to pick on banking here for a second. I apologize to the bankers, but you're here partly to address this concern that I'm about to raise here. The problem is that if you have bankers who are not educated on sort of the full consequences of borrowing, on full consequences of credit, including behavioral consequences, really it can feel like you're doing somebody a favor, right? So you help somebody to buy something they want to buy today. We don't think about long-term consequences. We think, yeah, perfect. I help that person to buy something they want to buy today. Okay, that's good. Yeah, and I think some of it, Shauna, is sort of weaving a behavior element to this. So now we're really, what's the word I'm looking for here? Integrating. We're integrating behavioral element plus sort of a long-term element. So we're not just dealing with credit as a kind of one and done engagement. We're now going to have the ability to do this kind of work. Okay. Right. That's my comment here, Shika, right? Yeah. And that's what, now, Kevin, I think it's okay to some extent to lend to wants, right? But we have to understand the trade-offs there too, right? And excessive lending to wants is what gets us into trouble, isn't it? But every now and then you're going to have somebody who doesn't really need a new car, but a new car is important to them, and they're going to finance the purchase of a new car, right? And again, there, understanding the trade-offs that person is making are important, right? Or getting that person to understand the trade-offs they're making by doing that is important. And the risk they're presenting to themselves. Okay, that's good. We see this meme floating around on Facebook, just to your comment, Kevin, where sort of, and maybe I shouldn't make light of it, but this comment that, you know, after 3 months of people, like midst of COVID, right? After 3 months of people only buying what they needed and not what they wanted, the economy had collapsed. So, yeah, I think there is something to that comment anyways. Okay. So, I don't know, is that a useful answer, Shauna? Yeah, and I have found this, just, you know, teaching the curriculum for a decade now, I have found that there was a deficiency here. This is something that I was really happy to see added to the curriculum. Better understanding of mortgages. We can give people, you know, potentially actually advice about when to refinance or not to refinance a mortgage. We can do some planning around mortgages. And I don't want to necessarily pick on the real estate industry, but to this point, a lot of that advice came from real estate agents. And real estate agents are not getting paid in any way, shape, or form to deliver advice. Okay, some do. I know some are really good with that kind of thing, and some real estate agents have a long-term perspective and will actually develop relationships and give advice, but that's not common in that industry. Okay, there you go, Aida, right? That's, if you get that question a lot, that really speaks to the importance of what we're looking at here. Okay. Now, who on the call actually learned the 5 C's of credit when they started in this business? I'm asking people to date themselves. I think, Mel, you did. Yeah, all right. Funny, Mel. All right. Greg, yeah, there you go, Shauna, right? Yeah, perfect, Elizabeth. It's a good tool, right? I find that this tends to be something more applicable to people who started in banking more than about a decade ago. Okay, there you go, Kevin, right? Recently, I find the 5 C's of credit are less taught. So you find newer bankers have not necessarily been exposed to this idea. And I understand why, but it's still a useful tool, okay? And ultimately, the 5 C's of credit are going to help us to answer almost any question around lending. So why could I borrow, or why could I not borrow, or why this rate, or really anything like this. Why was I forced to have collateral? Okay, whatever it is, somewhere that question is going to get answered in the 5 C's of credit. And it's why I'd like it. You're not going to have an exam question that asks you what the 5 C's of credit are. That's not why I teach this. I teach this because it's going to give us a foundational understanding. Okay. And you still see that to some extent today, Sue, with commercial lending, but certainly today in household lending, everything is much more data driven, isn't it? You fill out a form that essentially the underwriting department just compares it to, like, it's all automated, right? You compare it to some metrics, and if the client meets those metrics, good. If the client's sort of in a gray area, then it might go for some adjudication. If the client's miles out, then it's just going to be a no. Is that a fair comment, Sue? Yeah, and really pretty rare to have a human touch in there, right? Other than you just helping a client to understand the questions. Okay. Still, though, that back office system is using the 5 C's. And you're going to see the 5 C's. I know you know this, Sue. You're going to see the 5 C's show up in the questions that you ask. So as a potential lender, you're going to see all of these things represented in some way, shape, or form, or a potential borrower too. Okay. All right. So first off, collateral. And these are in no particular order, although I always do conditions last for some reason. Okay. Yeah, that makes a lot of sense, Mel, right? And especially if you were in that sort of like credit union, farm lending environment, right? Okay, so first off, collateral. So this is generally the thing that makes lending the easiest. If we can address this problem, it often takes away a bunch of other concerns. So the question here with collateral is, what represents good collateral? So does the lender have a legal way to access it? And this is where we see with mortgages in particular, every province has either a power of sale right or a foreclosure right. Okay, so power of sale or foreclosure against mortgages. So if you default on a mortgage, we don't have to go and invent the process every time. That we know exactly what that process is going to look like. And the financial institutions that do mortgages, they all have a sort of tried and true process for dealing with people who have missed their usually more than 3 mortgage payments and now are in arrears on their mortgage. Sorry, 3 months of mortgage payments. Okay. This gets trickier with assets that aren't real assets, as Chris points out, but rather chattel. So with car loans or that type of thing, now you get repossession, and that's a trickier one. Okay, that's one where your bank is not going to be excited about a repo process because you get into some actual physical risk here. The legal rights around this aren't as clear, so we have to really rely heavily on the contract. It's not such a good type of collateral. With investments, if I have investments as collateral, then we have this question about liquidity and ease of access. So is there some method that we can use to collateralize that asset? Those of you that do permanent insurance, for example, and this ties into the comment that Ron made earlier, I can take a universal life insurance policy that has a cash surrender value, and there's a specific section in both the Insurance Act and possibly in the contract for that policy that points to a collateral assignment of the policy. And we know exactly how that works, and there's a strong mechanism behind that. Okay, if you're on the IROC side and you have a client who's going to use derivatives, you typically have to have a margin account in place. And again, there's a structure around that. Kevin, I don't know if you have any clients who use derivatives, but there's a system for that within your institution. Is that fair? And nobody's kind of guessing what happens if the client doesn't make good on their on their obligations to you. Fair? So that's where we have this question of collateral. Now, not every kind of lending has collateral, but often with that good collateral, we get into secured lending, which is generally going to give us the lowest rates and the best terms and conditions overall. Okay, that's all good. Anybody see this article? Actually, I posted it up on LinkedIn, I think on my LinkedIn on Monday. This article, it was in the Global, and I didn't even know about this. I guess I just don't pay enough attention to this kind of lending, but they've been around since 2009. This, is it BrightPay or PayBright? Where you can borrow money to make purchases sub $100. So I want to go buy a new set of throw pillows for my couch, and I can finance that purchase. Anybody see this? Yeah, and there's a way to do it. They sort of heavily promote that they have some 0% lending available. It's not really clear how much of their lending is really 0% lending, but yeah, it's under $100, Michelle. Yeah, interesting, isn't it, Greg? So yeah, I don't, now they're sort of murky about other rates, Shika. So they have 0%, but they have other rates that are not so clear. All right, I just found it interesting. We talked about people getting themselves into trouble with borrowing. I think that's a really good example where people don't really understand what they're getting into. Okay. Yeah, right now, Olu, so you're on private chat there, Olu, but yeah, if you're buying a house today, you know, you can, like, that's a very cheap way to borrow money because the collateral is so good around that. Okay. All right. That's my comment there, right? Low rates, best terms. Okay. That's good. Oh, okay, I got it. All right. So then capacity. So what are we measuring with capacity? What's the sort of tool that we're using here? That's it, Shika, right? So this is TDS and GDS. And the question here is really, can you afford, exactly, your debt servicing ratios, can you afford to take on debt? Right. Now, it's a weird thing, Stuart. It's, I think that ability to pay is a pretty optimistic way to look at this. I think it really is the question I'm asking here. Can you afford to take on debt? Because this isn't so much about repayment ability, is it? Or if you just maybe finish that sentence with ability to pay interest, I think that's an accurate suggestion of what capacity is. I'm not sure about ability to make principal payments, but what do I know? So with TDS and GDS, these are typically used in housing related borrowing. Has anybody seen them used elsewhere? Any of our long-term lenders, people with a strong lending background, see them used anywhere else other than housing related? Okay, interesting, Stuart. Yeah, good stuff, Connor. All right. Oh, that makes sense. Debt consolidation, of course. Sure. Yeah, perfect. Okay, so so you're going to see them here, and then also, yes, this is a good point. We might see them for your single-purpose loan, Stuart, right? You might see them for, yeah, for leveraged investing. Good one, Connor. Yeah, and for debt consolidation. Yeah, lines of credit, that's fair. Yeah, perfect. Okay. Yeah, I haven't seen them used for business lending either. Baljeet, at least not explicitly, but I suppose it's possible. But housing is still the primary concern here. And yeah, it's a good point around GDS versus TDS. Oh yeah, so I don't want to get into that one, Kamal, but it's a valid point. And honestly, Kamal brings up a good point here in general. There is in chapter 3 a fairly in-depth section around student lending, okay? Both around the Canada and then provincial student loans programs, as well as the type of private institution education loans. Yeah, so it's going to be recorded, Richard, if you have to duck out. The recording will be available tomorrow morning. Okay. That's good. I can't imagine what you'd have to do that's more important than spending time with me. Come on. All right. Okay. I mean, catching a flight, I can live with that, Richard. All right. Okay. All right. So the two ratios that we see here are your gross debt service ratio. Okay. So gross debt service ratio is going to take into account your housing costs, which is going to be your principal, interest, and taxes on your mortgage, plus your heating costs. So sometimes you'll see that as PIF, whatever, and usually 50% of condo fees. That's normal. That's not a guarantee. It's not always going to be 50%, but that's a pretty common number. And then we're going to take that amount divided by your gross monthly income. And there is some variability here. If you're buying a rental property, for example, then we have to look at a bunch of secondary factors to determine whether the income from your rental property gets included in the gross monthly income calculation or whether it doesn't. Okay, but generally you're going to bring in what you spend every month divided by, what you spend on housing every month divided by what you make every month. And what's our upper limit for GDS? Yeah, somewhere in that ballpark, right? 32% is a pretty common number. It does vary a little bit. We'll talk about this when we talk about conditions on the bottom of the slide, but your limits here are going to be somewhere between 30 to 35%. Okay, the CMHC upper limit today is 35%, but financial institutions will generally have a lower limit than that. 32%, as a bunch of you pointed out, pretty common. Okay, but the financial institution could set it lower. They could say, whatever, we're going to be a little more risk averse, or maybe we're going to be a little more risk averse in this market, and we're going to knock it down to 30%. Or they might say, we want more of a certain kind of borrower in this market. So for this market, we're going to increase that up to 34%. Or it might be that they say it's going to be 34% on houses where the mortgage amount is going to be less than $400,000 and 32% where it's going to be more than $400,000. So you could do all kinds of things here. This really is going to come down to a best practices or a business practice decision for the lender. Okay. For those of you who are in lending, have you seen this where you've got your TDS or GDS moving around based on some sort of business objective? Anybody ever have this happen to them? Or have we just all been at 32% forever and ever? Yeah, you see that sometimes, Stuart, right? Okay. And then, of course, we have TDS. So TDS is going to use your GDS figures plus any other debt servicing. Okay, and again, divided by gross monthly income. Now, our other debt servicing, that's a very comprehensive list. There's a ton of stuff that can go into this. There's some stuff that's obvious. So any principal and interest payment on other debts. So yeah, and I addressed that in the textbook a little bit, Devin, because that's a little bit of a moving target. So you're going to have principal and interest on other loans. Okay, I'll talk about that in a second. Your line of credit and credit card. We're going to have any car financing. So if you have car loans or car leases. And the other big one that people get caught up on here is support payments. If you have spousal or child support, that's going to show up in here. And there's a bunch of other odds and ends, but really we have to look at every sort of debt-related obligation that you would have, and that does include child and spousal support. Even if you're in good standing on them, we still include them here. Now for line of credit and credit card, there's some variability here, and I'm interested to hear what people are seeing in real life around this. What's been sort of the historical thing to do here is to use somewhere between 3 to 5% of your available balance on both of these instruments. But I'm seeing this more and more, especially with lines of credit, where we're not using that, but rather we're using your minimum payment for the last 3 or 6 months or something like that. Okay. So yeah, and you still can see that, Mel. I have seen somewhere we're switching over to using an actual version of your monthly payment as the basis here. Okay. All right. That's good. For all the credit union folks, what are you seeing here? A whole bunch of you that do this day in and day out. Okay, who knows? I don't know. So anyways, we have this sort of variable range here, and yeah, I could buy 3% now. That's perfectly fine. Okay, thanks, Shika. Yeah. The outstanding balance, right? So you're not even talking about the available balance. You're talking about outstanding balance. So if I only owe $500 on there, it's really a negligible outcome, right? So you're saying 3%, and I agree both of these things are possible. Mal says 3% of the limit, you say 3% of outstanding balance. Those are two different things, aren't they? And hopefully they're quite different. Okay. Then we look at capital. Yeah, and you're only dealing with mortgages, lines of credits and the like, right, Mal? So a little different, and that's true. That's your sort of selling feature for your mortgage fund, isn't it? Okay. So what about capital here? What am I measuring with capital? What's the key item? Yeah, net worth. Okay. Yeah, and that's going to be measured. So that's a more precise breakdown, Shika, right? So we want to look at not just your overall net worth, but you're looking at how liquid are you across your various types of assets, right? Oh, sorry, Olu. Yeah, limit for TDS here is going to be around 40 to 45%. Okay. The limit today for CMHC borrowing, so an institution could set that limit as high as 45%. I often see that number at 42 or 44%. Okay. All right. So my capital here, yeah. So this is how much assets do you have? How much liability, and how liquid is it all? Okay, which is what Shika's referring to with how much is invested? What's your sort of fallback? How much ready cash do you have available? Okay. And this is not always considered. It depends on the kind of borrowing you're doing. This is often a bigger concern for larger amounts of unsecured borrowing, but we do pay attention to this in other places. All right, and then character. What are we using to measure character? So exactly, Kamal, this is going to be whatever we're calling that score, right? Your payment history, Mal, which is going to be primarily reflected in your Beacon score or your credit score or your bureau or whatever we're calling that thing today, okay? That's good. And yes, exactly, that item, that credit score, that Beacon score is based on your payment history. There are 5 things that go into that calculation: payment history, your employment, and that ties into that financial maturity. What else do we care about here with your Beacon score, credit score? So that's going to show up in payment history, Kamal. Yeah, that missed payment would show up in there, right? And yeah, that's the same thing. The derogatory message is going to come about from a missed payment, right? So your available and type of credit too, Jen, right? Okay. Again, collections activity and bankruptcy are going to show up in payment history. Yeah, so your credit applications, perfect. So the assumption, Fatima, this is a good point. The assumption with your Beacon score is that it represents your attitude towards debt. Okay. Yeah, that's the Shika, that's that type and availability of credit. And then the other would be the amount of your credit used. Okay, those are the 5 factors that go into the calculation of this Beacon score. Now, we don't know exactly how they're all weighted. Okay. So, and I talked about employment, but yeah, Shika's right here. We could talk about financial maturity here as well, because, for example, the longer you've been in the same house, the more beneficial this is. Okay. All right. Any questions there? And then what's going to happen, of course, is the lender will have some minimum criteria. This ties into your comment, Mal, about IG and its mortgages. Everybody's going to have this to some extent. Okay, where we're going to have some minimum credit score for different types of lending. So whatever it is, maybe you have a minimum 620 to get a mortgage from a given institution or whatever, right? I don't know that it's 620. That's just an example, but that's what you're going to see is that if you don't sort of break through a certain barrier, you're going to be disqualified from certain types of lending. And by the way, this is not only a concern for lending, is it? Where else do you see credit scores checked? So yeah, your cell phone, which honestly is a kind of lending, but yeah, you're going to pull a credit check typically to get a cell phone. Some jobs, Shika, right? Notably in banks, right? In some provinces, we can do this for auto insurance. Okay, it's true. So Elizabeth and Chris both have the same comment here. Compliance, which ties sort of into your jobs, right? But compliance for life insurance agents. Okay. Yeah, I thought I had rent on there. Sorry, renting. I missed that. Renting an apartment. Yeah, absolutely. Okay. Yeah. Okay, and that's a little bit of a red flag, yellow flag situation, right, Chris? That's, you want to stay in good standing there because you know if that falls. So yeah, bankruptcy can, Shika, that's true, but that's not specifically related to your credit score, right? So I agree with you that you don't want to be bankrupt because it's hard to stay employed as a financial services person that way. But, and same for the CFP certification, Shika. Personal bankruptcy is a bar to certification as well. Okay. Okay. Anything else? All right, that's good. So your credit score is material. Now, that being said, I do see in sort of the personal finance world, this, like, financial bloggers will say, have this overwhelming focus on credit scores. And for most people, as long as your credit score isn't in the toilet, you're probably going to be able to do pretty much anything just by maintaining a reasonable degree of care for your credit score. I would suggest that for most people, it doesn't really matter if you're a 770 or an 850. Is that a fair comment? Or do you think I'm underselling the credit score? Okay. Now, if you're a 550, yeah, you're going to start to lose some opportunities, right? Yeah, that's most likely the case, Stuart. So Shika, how often does that matter though? How often are people doing unsecured borrowing? What kinds of things are people borrowing money for there? Maybe RSP loan. And even there, how much does my rate on an RSP loan really matter? You're typically only borrowing for a few months, right? Interest is a relatively inconsequential thing there. That's my point, Chick, is how often are people actually borrowing money like that? Okay. Plus, I don't even need to do that anymore, Shika, because remember, I can borrow to make those sub $100 purchases. So I don't need to deal with a banker anymore. Remember that? Okay. So then, conditions. And we've talked about this all the way through. We've interwoven this into the discussion all the way through. This is the financial institution and government conditions around lending. Okay. And really, it's what are the barriers or the limits? Sometimes it's regulatory, sometimes it's about a business model, sometimes it's about having a pool of risk that just looks a certain way, where we don't have all of our mortgages in one category or in one geographic region or with one type of employee or whatever the case is. Okay, that's good. And of course, the biggest one that you're concerned with here is CMHC, right? So we have our CMHC rules govern some mortgage lending. And I want to emphasize this, that we pay a lot of attention to CMHC rules, but in the end, this only impacts about 2/3 of residential mortgages. Okay, so about 2/3 of residential mortgages are CMHC insured, and those are the ones that follow those federal guidelines. So when we talk about a maximum TDS and maximum GDS, when we talk about a 5-year posted rate and having to use that 5-year posted rate in certain mortgage calculations, when we talk about a minimum 5% down payment and the effect of borrowed money on that, those are all CMHC rules. For a non-CMHC lender, they do not have to follow that same set of rules. That's good. Now, there are some limits for federally incorporated entities versus provincially incorporated entities. So you really have kind of, we'll say, 3 pools here. You have the CMHC lender, you have the non-CMHC federal lender, and then you have provincial lenders. And those are all going to follow different sets of rules. So we have a whole bunch of folks on the call from a provincial credit union here in Alberta. And you may find that you're borrowing under different terms there than you would if you went to a federally incorporated bank in the same city. That's fair? I find people sometimes get confused around that issue. But it's worth recognizing that not everything is a CMHC insured mortgage, and we don't have to necessarily worry about those CMHC rules, although I think that it's healthy to respect those. Those are generally going to create safer outcomes for borrowers. All right. Any questions about the 5 C's? Okay, perfect. So do you think they are, Baljit? I don't know. Yeah, max 4%, Nadia, right? Max 4%. Okay. I don't know if that's ridiculous. That seems to me, I mean, for the ability to borrow several hundreds of thousands of dollars, it doesn't feel that much to me. Yeah, again, though, Baljit, I mean, you finance that cost, and otherwise you don't get the house, right? Okay, I mean, your client could have saved their $70,000 and not had to do it, right? Or even saved, what, 40,000 and cut that in half? Yeah. Okay. So I don't want to look at every kind of lending. I want to have a quick look at mortgages here. We'll get into this and we'll take a coffee break. So with mortgages, there's a whole bunch of sort of moving parts to a mortgage. I covered off a small number of them here. And I'm most concerned about people who don't live in the mortgage world, just having familiarity with the language here. So when we talk about the term of the mortgage, what am I referring to? Yeah, years until what? So it could be fixed or variable. Yeah, that's it, Michelle, right? So it's how long before renewal? Yeah, how long are my current conditions in place? Okay, that's good. And the idea here then, yes, at the end of the term or near the end of the term, I will renegotiate my mortgage, which I can't spell. Negotiate my mortgage. There we go. Okay. Now, whatever the term of the initial term of the mortgage is, the assumption is that's going to be what your mortgage is for the rest of the amortization period, which is often not the case. Okay. That's all good. And for that matter, you could pay your mortgage in full at the end of your term. And there will be no penalty to do so. Okay. What are the typical terms we see for a mortgage? Four years, Olu. Not that common, right? Thanks, Yuri. All right, but you could, yeah. Can I go less than a year? I can, right? Can I go longer than 5 years? I can, right? So you'll see sort of 3, 4, 5 years are common terms, but you can go just a few months, and that exactly goes back to the open mortgage comment, okay? So you can have just a few months, And typically those are open mortgages and usually builder's mortgages or transitional mortgages, right? So we sometimes have a mortgage where you're just selling your old place, buying a new place, and we're typically going to have a little bit of a higher rate on that type of mortgage. And yes, 7 and 10-year terms are available, Shika, right? But not very common. Fair? Ada, that's true, isn't it? How do you see somebody actually take a 10-year term? Okay. So you could have an exam question. This is where we get into sort of your typical exam question. And what you might have here is a fairly detailed client scenario. And you might have the type of combination questions that we've seen before, where you have a choice between a 3-year term and a 5-year term. And you're expected to match that up to the client circumstances. So what you'd want to watch for there is there some sort of uncertainty? Is there maybe a thought that they might move? Is there some benefit to the 5-year mortgage versus the 3-year mortgage? Is the 5-year mortgage portable, that the 3-year mortgage is not? What's going on that might favor one of those two mortgages? That's fair? Okay. And honestly, that kind of question shouldn't be that difficult as long as you pay attention to the information in the case study, in the scenario. If you see something like that, a choice between a 3- and 5-year term, there's something in the case study that points to a shorter or longer term. Okay. All right. Then we look at an amortization period. So what does amortization period refer to? And we'll go through this and we'll take our coffee break. Yeah, that's when is your mortgage balance going to be 0? Okay. Yeah, and this assumes that your rate is unchanged and it assumes a certain payment schedule, and you might be able to shave some time off of this by using an accelerated schedule. And I know that's very popular today, right? A lot of people like to go with an accelerated weekly or even accelerated biweekly schedule to shave a few even years off of your amortization period, right? But we're still using that, whatever, typically 20 years as our amortization period. Anybody see a mortgage recently with an amortization period other than 25 years? You can do it, Connor, right? With a non-CMHC lender, you can do 30 years, 5 years. Interesting. Was that a commercial or a rental? Yeah, on conventional, so a non-insured. Yeah, interesting. So that, Elizabeth, goes back to that non-CMHC rule. Okay, so a CMHC mortgage, you're going to do 25 years, but to Connor's comment here, if I have my 20% down, I'm not using the CMHC rules anymore. Okay, that's good. And in theory, Stuart, I could still do 35 or 40 years if I'm not using CMHC insured mortgages, but I don't know of any financial institution in Canada that's doing 35 or 40 on at least first residential mortgages. Okay. Yeah, and even then, you're only doing 30 years on a non-CMHC mortgage, right? Okay, perfect. Right. Okay. Yeah, I think, Fatima, this is kind of the point, and actually, Baljit is a curious question or a curious point to raise around this. If I'm writing a financial plan for a client today, right, to me, what we should be doing, Fatima, in general, with any financial plan, is addressing uncertainty, right? So I can write a financial plan that says, if nothing ever changes, here's where you're going to end up. But we know that things are going to change, right? So to me, a good financial plan is going to include a number of scenarios. Now, I don't need 25 scenarios, right? But maybe I'm going to have 2 or 3 scenarios in there that represent risks that are real to my client. Are you with me here? Where if those risks materialize, they become sort of important in the financial plan. Now, who had a pandemic in 2020 in their financial plan for their clients? Right, nobody had that, Elizabeth. But if I wrote a financial plan for my client in 2016, I might have shown the impact of a short-term disability. Is that fair? And if I had that impact in there, or a job loss, right? If I had that impact in there, then my client realized that they needed a better emergency fund. Maybe they realized that they needed to reduce some of their borrowing. And so maybe they weren't exactly prepared for a pandemic, but preparing for that short-term disability would have prepared them for a lot of the same outcomes as we get with a pandemic. Is that fair? Do you think I'm overvaluing the financial plan there? Right. So I can't know everything that's going to change, Fatima, but I think if I do a good job of picking sort of 2 or 3 representative risks, then when something materializes, we're prepared to react to it. Okay. So I don't think I want to focus on, exactly what happens if rates increase. Now that might be it, right? So that might be a good risk to focus on for a client who does take out a mortgage today. So let's say I have a client who buys their first house today, and they get a 2% interest rate. Well, what if you have to renew into a 4% environment is probably a good risk to work through with that person. Okay. Oh, we can't talk about pre-qualification yet, Ron. Did you read ahead in the slide deck? Okay. All right. I like it, Ron. All right. All good? Okay. I like that question, Fatima. I think it's a good question to be thinking about, is really how much uncertainty can I plan around and what does that look like? I think it really does tie into the philosophical purpose of the financial plan. Okay. Let's take a break there. We're a little bit past coffee break now. And we'll come back after coffee break. We'll finish this slide, and then we'll get into our multiple choice questions for today. So I have 3 minutes after the hour. Let's take 15 minutes. We'll resume at 18 past. Okay, we'll see you back then. Thanks.